You've seen the headlines. Silver breakout. $50 silver imminent. The bull market is just getting started. And now, almost overnight, the tone shifts. Blow off top? Is silver rolling over? Was that the peak? If you've been in the precious metals space for more than 5 minutes, you know how quickly sentiment can flip. When silver moves aggressively toward the mid-30s, the excitement builds fast. And when it pulls back $2 or $3, the same voices that were euphoric suddenly start talking about collapse. So the real question is simple. Is the silver bull market finally over, or are we just seeing a normal reset inside a larger move? In today's video, I'm going to walk you through the actual data, not the emotion, not the thumbnails, not the hype. We'll look at price structure, macro drivers, positioning, and cross-market signals. We'll lay out the bull case, the bear case, and the middle path. And at the end, I'll show you exactly what I'm doing with my own allocation. This is financial briefing. Calm, data-driven, no clickbait. Let's get into it. Over the past year, I've made a few clear calls on this channel, and I think it's important to start there. Back in late 2023, when silver was trading around $23, I said the risk-reward favored the upside into the high 20s if real yields stabilized. Within 4 months, we saw silver push through $27. That played out as expected. In early 2024, when silver first approached $30, I cautioned that we were stretched short-term and likely to see a retracement back toward the 50-week moving average. We pulled back to $26 before resuming higher. Again, that scenario largely unfolded. More recently, as silver ran from $28 to $34 in a relatively tight window, I said momentum was strong, but sentiment was overheating. I expected either consolidation or a 10-15% pullback before any sustainable move higher. We've since seen a retrace toward the $31-$30 range. That's not perfection. Markets don't move in straight lines, but the framework has been consistent. Probabilities, not predictions. Risk management, not bravado. So now let's talk about the data that actually matters. First data point, price structure and momentum. As of this recording, silver is trading roughly between $31 and $33, after recently touching the mid-$34 range. That move from the mid-20s to the mid-30s represented roughly a 30 to 35% rally in under 6 months. Historically, when silver rallies more than 30% in less than half a year, we almost always see some form of consolidation. If you look back to 2016, silver rallied from $14 to $21 in about 7 months, roughly 50%. That was followed by a sharp pullback of nearly 30%. In 2020, silver ran from $18 to almost $30 in 5 months, a 66% move, and then corrected back toward $22 before resuming its broader trend. Right now, the weekly RSI has cooled from overbought levels above 70 back into the low 60s. That tells us momentum has normalized, but it hasn't collapsed. What this means is that the recent pullback is not structurally unusual. It fits the pattern of prior bull phases: surge, cool off, reset. What it doesn't mean is that we've entered a confirmed bear market. A bear market typically involves lower highs and lower lows on the weekly time frame, accompanied by a breakdown below major moving averages. We haven't seen that yet. The 200-week moving average is still far below current price, and the 50-week moving average is trending upward. So, technically speaking, we're in a cooling phase, not a confirmed reversal. Second data point, real yields and macro conditions. Silver, like gold, is highly sensitive to real interest rates. That is, nominal yields minus inflation. When real yields rise sharply, precious metals tend to struggle. When real yields fall or stabilize, metals often gain traction. Currently, the U.S. market 10-year Treasury yield is hovering in the mid-4% range, while inflation expectations are roughly around 2.3 to 2.5%. That puts real yields in the 1.52% range, still historically elevated compared to the ultra-low real yield environment of 2020. In 2020, real yields went negative, as low as negative 1%. That was rocket fuel for silver. Today, we're not in that environment. We're in a restrictive but potentially peaking rate regime. What this means is that silver's recent rally has occurred despite relatively high real yields. That suggests strength under the surface, possibly driven by industrial demand, central bank diversification trends influencing gold, and spill over into silver. What it doesn't mean is that silver is immune to higher yields. If 10-year yields push back above 4.75% and inflation cools further, real yields could rise again, and that would create headwinds. So macro isn't screaming collapse, but it's also not screaming breakout. Third data point, physical and industrial demand. Roughly 50-55% of silver demand comes from industrial uses. Solar panels, electronics, EV components. In 2023 and 2024, global solar installations hit record levels, pushing silver demand for photovoltaics to all-time highs, over 150 million ounces annually in some estimates. At the same time, mine supply growth has been relatively constrained. Global silver production has not dramatically expanded. Several large producers are facing cost pressures, environmental constraints, and declining ore grades. This has led to persistent supply deficits on the order of 100-200 million ounces in some recent annual reports. What this means is that the long-term structural case for silver remains intact. There is a legitimate industrial underpinning. What it doesn't mean is that price must immediately explode higher. Commodity markets can remain in deficit while prices move sideways. Inventories, substitution, and financial flows can offset fundamentals in the short term. So when you combine technical structure, macro drivers, and supply-demand data, the picture is mixed but not catastrophic. Now let's lay out the bull case. The bullish scenario for silver from here rests on a few pillars. First, rate cuts. If the Federal Reserve begins easing later this year and 10-year yields drift lower toward 3.54%, real yields could compress. That historically supports precious metals. Second, a weakening US dollar. Silver tends to perform well when the dollar index trends lower. If DXY breaks below key support levels and capital flows shift toward commodities, silver could benefit. Third, industrial momentum. If global green energy investment continues at record pace and solar demand remains strong, physical deficits could tighten further, creating a floor under price. Fourth, technical breakout continuation. If silver reclaims and holds above $35 on strong volume, it would break a multi-year resistance zone dating back to 2012-2013. That could trigger systematic and momentum-based buying. If those elements align, we could see silver test $38.42 within the next 12 months. But I want to be disciplined here. Given current macro uncertainty and relatively elevated real yields, I assign roughly a 30% probability to this aggressive bullish continuation scenario. Not impossible, not dominant, but meaningful. Now the bear case. First, sticky inflation combined with stubbornly high yields. If inflation remains above target, but the Fed delays rate cuts, nominal yields could remain elevated or even rise. Real yields staying near 2% historically limit upside in metals. Second, dollar strength. If global growth weakens and capital flows into the dollar as a safe haven, DXY could strengthen. That would typically pressure silver. Third, economic slowdown. While silver has monetary characteristics, more than half its demand is industrial. A sharp global slowdown or recession could reduce fabrication demand. Fourth, sentiment exhaustion. Silver is historically volatile. If speculative positioning is crowded and momentum funds unwind, we could see a swift move back toward 27-29. In a bearish scenario, silver could retrace 15-20% from recent highs, potentially testing the high 20s before stabilizing. I assign roughly a 35% probability to this bearish pullback scenario. Higher than the bull case, but not dominant. Which brings us to the middle path, the scenario I currently view as most likely. In this scenario, silver does not collapse. It also does not explode. Instead, it consolidates in a broad range, roughly $28 to $35 over the next 6 to 9 months. Volatility remains elevated. We see spikes on macro headlines. But structurally, the market digests prior gains while waiting for clearer signals on rates and growth. This type of sideways digestion is extremely common after 30-40% rallies. It shakes out weak hands, rebuilds energy, and resets positioning. I assign about a 45% probability to this consolidation scenario. Now let's zoom out historically. The closest parallel I see is 2016. Silver broke out from multi-year lows around $14, rallied aggressively to $21, then pulled back sharply to $16 before gradually basing. Similarities: rapid percentage gains, elevated sentiment, media excitement, and then a cooling phase. Differences: in 2016, inflation was relatively muted, and the Fed was early in its hiking cycle. Today, we're late in a tightening cycle with structurally higher inflation pressures and significant geopolitical uncertainty. Another comparison is 2020-2021. Silver spiked to nearly $30 during pandemic stimulus, then spent almost 3 years, chopping between $18 and $26 before breaking higher again. The key lesson from history is this: silver bull markets are not smooth, they are volatile, frustrating, and full of sharp corrections. That doesn't mean they're over. It means they're behaving normally. Now let's look at cross-market signals. Gold is currently holding above $2,000 and, in some recent months, has pushed toward $2,200. That strength in gold provides a supportive backdrop for silver. When gold remains firm, it reduces downside pressure on silver. The US dollar index is fluctuating in the 102 to 105 range, not collapsing, not surging. A decisive break below 100 would likely be bullish for metals. A break above 107 would likely create headwinds. The 10-year yield, as mentioned earlier, is in the mid 4% range. If that drifts lower toward 3.75%, I'd expect metals to catch a bid. If it spikes toward 5%, silver will struggle. Right now, cross-market signals are neutral to mildly supportive. They are not flashing red. Positioning adds another layer. Recent QOT reports show managed money net long positions in silver elevated but not at extreme historical peaks. Commercial hedgers have increased short exposure somewhat, which is typical into rallies, but not at panic levels. In prior major tops, we've seen extreme speculative longs combined with aggressive commercial shorts. We're elevated, but not euphoric. That suggests vulnerability to pullbacks, but not necessarily a major top. So what am I doing? Here's my framework. If silver breaks and holds above $35 on weekly closes, accompanied by declining yields and a softer dollar, I will increase my allocation by 5 to 7%, targeting a move toward $40 over the next 6 to 12 months. If silver breaks below $29 on strong volume, while yields rise above 4.75%, I will reduce exposure by 5 to 10% and wait for stabilization near $26, $27. If silver remains between $30 and $34, I will maintain current allocation and selectively add on dips near major support. Currently, my portfolio allocation to precious metals is approximately 18% total, with about 11% in gold and 7% in silver. Within that silver exposure, roughly half is physical, half is liquid instruments. My stop-loss framework for liquid silver positions sits around $28 on a weekly close. My first take-profit zone for tactical trades is around $38. Not advice, just my framework. And just as important as what I'm doing is what I'm not doing. I'm not panic buying because of headlines calling for $50 silver next month. I'm not selling everything because of a $2 pullback. And I'm not consuming fear-driven content that frames every consolidation as systemic collapse. Silver is volatile. That's not new. As for what I'm watching this week, 3 things stand out. First, the 10-year Treasury yield. If we see a sustained move below 4.2%, that would be bullish for metals. If yields spike above 4.6%, that's a caution flag. Second, the dollar index. A break below 101 would likely support silver. A rally above 106 would create pressure. Third, silver's own price structure. I'm watching the $30 to $31 support zone closely. A strong bounce there is constructive. A decisive break below with heavy volume changes the short-term outlook. So is the silver bull market finally over? Here's the summary. Silver has pulled back after a strong rally. That's normal. Macro conditions are mixed, not hostile. Positioning is elevated, but not extreme. And the most likely outcome, in my view, is consolidation rather than collapse. If you found this helpful, subscribe for calm, data-driven precious metals analysis. No hype, no panic. This is Financial Briefing. Stay sharp. Silver crash or bull market pause? The data. No one is showing you.